Current account deficit is generally currency negative, and indeed on the latest news the rand weakened to around 10.90 to the dollar, overshooting its recent stable range of 10.50 to 10.75 against the dollar. The impact of the platinum strike, among other things, dented exports during the second quarter.
On the trade account, our imports actually came down a bit, but our exports came down even more, and part of the reason for that, I think, had to do with the strike activity. Part of the reason was also a deterioration in export prices, so we did not get as much for our exports as before. On the other account, that is now on the services and income account of the balance of payments, there we found that we had fairly strong dividend inflows in the first quarter of this year. In the second quarter it was not as strong as it was in the first quarter, and that was the main contributor then to a widening also of the deficit on the services and income account.
Analysts say South Africa's economy is not properly wired, and that deficits will remain the order of the day if the way the economy runs stays the same.
What the widening of the current account deficit tells us is that the structures of the South African economy are extremely weak at the moment. We are unable to produce enough of what we need and are ever more reliant on foreigners to supply both the goods and services that we need, as well as the capital to actually accommodate this. And we are going to become more and more indebted to foreign companies, to foreign donors and to others, and to foreign banks.
Gross fixed capital formation, in other words capital investment, decelerated to 0.5% of GDP in the second quarter, compared to over 2% in the first, with particular weakness coming from the private sector. It's
a reflection of a definite decline in the level of business confidence in the long-term future of the country. It is concerning because if we don't invest more now, we will not be able to sustain higher levels of economic growth in the longer term.
On the consumer front, there was a little bit of good news.
The consumer level of debt relative to income came down a bit again in the second quarter of this year, which now continues a trend which has come since about the financial crisis, 2008-2009 to now, and it has come down from more than 80% of annual income, actually 82% of annual income, down now to a bit less than 74% of annual income.
But that's little consolation for households suffering from unemployment and those that had to go into deeper debt just to get the basics during the 5-month platinum strike, as mine workers were not paid during the period. Nompumelelo Siziba, SABC News, Pretoria.